we've touched on your markets, your mergers, and the history, but with, especially in this 4% 10-year market that we're in right now, rising interest rates, et cetera, with the traditional acquisitions market going through a reset or a rediscovery phase, how are you guys positioned for external growth?
Well, we think that we are positioned in the strongest position we've ever been. It starts with the balance sheet. I think anytime you start thinking about growth, you got to start with the balance sheet. And where is it? Earlier this year, before the run-up in interest rates, we were very proactive, went out and renegotiated our current credit facility. So we expanded that, and we are now at a credit facility of $1.2 billion that's expandable up to $2 billion. At the end of the second quarter, we had nothing barred against that. If you look at our overall debt to EBITDA, we're at 3.97, well below the sector average. Our average maturity of our debt now is well over 8 years, 8.2, 8.3 years. So we feel like at this point we're protected against rising. 100% of our debt is fixed. We're not floating anything. So we've got we think a lot of protection against rising rates over the next few years, and we've got a lot of capacity. So you'll see, and of course, the acquisition market has been so competitive over the last few years. We just been scratching our head trying to rationalize some of the pricing that we were seeing paid on some of the acquisitions. But that has begun to change, and it began to change about 6 months ago. We have recently completed 2 acquisitions. We bought a new property down in Tampa, Florida recently, and just closed on one about 3 weeks ago in Charlotte, North Carolina. We've also been active, back to my point earlier about Post Properties, active in sort of growing our development pipeline. We'll have a little over $1 billion of active construction underway by this time next year. We're just getting ready to start 2 new projects between now and the end of the year. And we've got 8 other projects scheduled to start next year. So we think that we think that the acquisition environment is likely to become a little bit more attractive to us over the coming year as rising interest rates continue to have an impact on the higher leverage buyers. And our track record of closing quick all cash continues to fuel more and more opportunity coming our way. So I'm excited that our external growth opportunity is likely to get much more active over the next 2 or 3 years.
I mean, I do want to. We'll come back to that because I have a few questions about M&A. Your thoughts about M&A in the future. REITs with strong balance sheets tend to have a competitive upper hand when dislocation enters the capital markets we've been talking about. You're talking about how your balance sheet is positioned during these difficult times with rising interest rates and a growing risk of recession. What if we still keep raising? We're still okay, raising rates. Like, we don't know what it looks like a year from now.
Yeah.
I mean, again, home prices are starting to come down a little bit, but we still know that the affordable house doesn't exist, and that's why you've seen a big growth of these, build to rent platforms that some of your peers have gotten involved with. Mm-hmm. So, how do you see? You've mentioned your $1 billion pipeline, as well as some acquisition opportunities that are out there, but are there I'll just ask, other M&A opportunities? Do you think we have too many apartment REITs that are out there today? Based off of your size and strength of where you guys are at, could we, be seeing some other deals down the road? And not saying, obviously, you can talk about anything, but what's your thoughts on the environment today?
Well, I do think that it's likely that we'll certainly see more M&A in the sector over the coming years. I don't have anything in particular to point to other than, we have.
You could talk about Blackstone with what they've done with Blue Rock, and
we've certainly seen private equity on the M&A side pretty active over the last few years, and but I think that's for several reasons. I think has slowed considerably, and but I do think that one of the things that's going to continue to be increasingly apparent in our industry, and I hope to the capital markets, is that these platforms that we are building, these larger platforms that are getting compiled as a function of external growth and M&A, these larger scale platforms increasingly are going to, I think, create a differentiation in the industry that is going to be hugely advantageous. As I was talking earlier about the investment in technology and the things that we're doing there, and just the what it takes in the way of staffing and what it takes in the way of investment in technology infrastructure is meaningful. And I think you have to get to a certain scale before you can really begin to disperse that investment over a larger asset base and over a larger revenue stream. I think the cost of being a public company just continues to go up, and I think what will happen over time is I think some of the smaller platforms will find it increasingly challenging to drive margins and ultimately returns to capital that will be comparable to what some of the larger platforms are able to do because of the things I just mentioned, but also just advantages of scale. Whether it's buying insurance or whether it's buying appliances, paint, whatever, there are certain advantages to scale that we have, and so I think that at the end, ultimately, capital needs to divert its focus to where am I going to obviously generate the best margin and from an operating perspective, and ultimately the best returns to capital. And I also believe that that these public platforms, as compared to some of the private equity platforms, when you get the transparency benefits that you get as a public, that the strength of the balance sheet, the lower leverage position that we have, the ability to withstand these cycles, the performance and track record that we're able to show is in a lot of these big public platforms in terms of dividend paying strength over a long period of time through all phases of the cycle. I think ultimately investment capital needs to find and understand, I think, the benefits of scale for where they want to direct their capital. And I think ultimately the public platforms have an advantage over a long period of time that I think is going to become increasingly apparent, that advantage, and hopefully appealing. I get it. The public markets can have volatility associated with them, whereas the private guys are, avoiding a lot of that so-called volatility by, not as active mark-to-market as we have as a public company. But volatility it can be frustrating at times, but it also can be hugely advantageous. And I think public companies that understand that and are positioned to take advantage of that are going to do well for shareholder capital over time. So I'm excited about the where we are, and I think you're going to continue to see the industry continue to consolidate, and I think the public platforms are going to continue to over time demonstrate an advantage that hopefully capital will be attracted to.
Well, we know that BREIT's like a $70 billion vehicle today, and yet we talk about through COVID how many hundreds of billions of dollars the REIT industry as a whole raised because of the tenure being at a one and change. No such thing as free money, free lunch, but it was basically free money for the entire, especially for guys that have the balance sheet of your capacity. That was free money that was out there. And you guys could go out and raise $500 million like that, literally overnight, whereas the private guys may have to spend a little bit of time putting the coffers together to try to put that together. And it's just mind-boggling. Like Realty Income did a $750 million deal yesterday like that. And who thought the deal markets were dead when we're seeing all of this volatility in the market, this rising interest rate environment. M&A is clearly not dead out there. And so it's really exciting to hear your thoughts on that. Based off your current geographic footprint, do you think that there could be any material additions or subtractions to the map over the next 3 to 5 years? You mentioned going into some of those secondary markets like Jacksonville. When I think of secondary and tertiary, it's again, where's that puck going to be? Does that mean next would be like Omaha and Wichita and Tulsa? Like where do we see that going over the next few years?
Well, I mean, broadly, we like the footprint we have. We are continuing to. We recently announced, probably a year or so ago, we entered the Salt Lake City market, and I think, as far as I know, we're the only REIT there. Certainly, I know we are the only apartment REIT there. But we like the dynamics for a market like Salt Lake City. It's a great quality of life. It appeals to a lot of young people. A lot of technology jobs are coming out of the West Coast markets into that market. But we fairly recent into the Denver market, and we're expanding our presence there in Denver. Another market that has been on our radar screen from time to time is a secondary marketplace like Columbus, Ohio. With a great education facility there, and what we're finding, a lot of entrepreneurs go there, come out of school and stay there, and so it comes down to what are the attributes of the city from an ability to attract employers, attract jobs, and therefore drive demand for housing. And I think that we continue to. I mean, I've been to Tulsa, I've been to Oklahoma City, I've looked at those markets. We to date have just not found anything there that was particularly compelling. But broadly, I can tell you that we are going to continue to obviously keep our orientation towards the Sunbelt markets. We're looking for markets that offer attributes that are likely to find. Draw employers into the market, and ultimately jobs and households and population growth. And so we'll continue to look in all those markets. We've been in Savannah, Georgia recently. We continue to look at some other markets in Florida. Obviously, Nashville for many years was viewed as a sleepy secondary market. We've been there forever, and that the secret's out on Nashville now. I mean, everybody's there. Or trying to get there, and
just like every other city in the country is opening a hot chicken place as well. So Nashville's everywhere.
But we will largely keep the footprint that we have, and we may tinker at the edges a little bit, but the strategy is not going to change.
You did mention yesterday, obviously, you guys put out your third quarter earnings date for the end of the month, so. We are assuming that you'll provide some preliminary 23 operating guidance over the next few weeks. But whether you can comment or not, do you think next year will be the great normalization in terms of metrics like blended lease growth, resident turnover, and occupancy? What about operating expense growth as well?
Well, I think that I think 23 is likely to continue to show performance trends that will be, I would say, better than long-term averages. And I think that's going to be a consequence of fact is we're carrying a lot of momentum into 2023. And so a lot of the rent growth, a lot of the pricing that has taken place with rent increases on new leases and renewals over the summer months, the summer leasing season, that momentum will carry into 2023. It's what we refer to as earn in for the next year is frankly going to be higher than it's ever been for us. And so there will be some positive momentum we will see in that regard. I think that, we continue to see, absent a full-scale severe recession, we continue to believe that the demand side of the business is holding up quite well. Single-family homes, while moderating perhaps just a little bit, as you mentioned a moment ago, are still by any measure still very expensive, particularly at the starter home level, which is where we lose residents to sometimes. So I think that math is still working in our favor, if you will, and I think that will continue well into next year. So, I continue to feel pretty good about the revenue side of the business going into next year. Our biggest challenge, frankly, is we're just comparing against tougher prior year comparisons than we've ever had. But I think by any sort of measure of historical norms, you're going to see revenue trends that are likely to be, a lot better than anything that we've seen.
So if you go from 17% NOI growth to, let's say, 9 or 10% by the third quarter of next year, still very solid NOI growth, but a very difficult comp to beat. And so focus on the here and now. We're still putting up considerable growth here.
Yeah,
Focus on
absolutely,
this.
absolutely. And I will say on the expense side of the business, I mean, obviously we've seen some pressure this year as a consequence of inflation, some supply chain issues, and we've had to make changes in terms of certain products that we use on the maintenance and repair side. We've seen it's been a tough labor market. I think that what we will see next year is growing benefits that we are going to be capturing from some of this new technology that I mentioned earlier that's coming in, that's going to have some staffing opportunities for us going into next year that will create some degree of relief. I do think that some of the supply chain issues are starting to slowly sort themselves out a little bit, which is likely to create some relief. And of course, we'll be comparing in some ways, if you will, against easier comps because this year we did see a run up in operating expenses. And so I think that, while there will certainly be some challenges, continued challenges from just normal inflationary pressures, and I think the labor market will continue to be challenging in some ways. I would be surprised to see expense pressures be as much of an issue next year. But I think overall, without a doubt, I feel confident that NOI trends going into next year will still be well above our historic norms.
And I just want to pause and note that for all REITs that are out there right now, if you listen to their quarterly earnings cycle when they do their announcement as well as the press conference, I believe you guys do this as well. It's what do we do year over year? But you guys are also talking about pre-pandemic versus our 2019 levels. We have far surpassed where we were in 2019 before things started to go downhill. And so I stress to all investors when people are talking about versus 2019, they're basically saying, ignore what happened in 2021. That was just a blip on the radar. Here we are versus 19. And look, we're actually doing better. And so we're knocking the cover off the ball right now. And so you're basically saying, look into 23, obviously too soon to talk about 24, but you still feel there's a lot of tailwinds for you guys.
Yeah, I do. I think that, the biggest headwind, if you will, that we'll have next year is that I do think that you'll see new supply levels pick up a little bit in certain submarkets across the markets we do business in. And that's a consequence of in early 2020, as the pandemic hit, a lot of construction sort of, held in place and a lot of projects held in place. And by late 20 into 2021, a lot of activities resumed. And so what we will see occur in 2023 and 2024 is delivery of some of that supply that got sort of going again in 2020 and 2021. But again, I'm not particularly concerned about it, but given the, sort of the unique way we are diversified across the Sun Belt, given the price point that we offer to the market, I think, and particularly what we see happening on the demand side of the business, I think that it comes together to create a leasing environment next year that I think is still going to be pretty positive. But it's interesting to also, though, take note of the fact that given what has happened with land pricing over the past 12 to 24 months, which has just been incredibly high, what's happened with construction costs, what's happening with cities and local governments' abilities to process permitting, which has really hit the skids and slowed down considerably. We are seeing a lot of evidence now that new construction starts are really starting to slow, which says good things for 2025 and 2026. So, again, over 28 years, we've seen this before. This business is still very cyclical in nature, and we'll go through periods of time where supply will pick up. And in our case, while we may see a little moderation in certain submarkets here and there as a consequence of supply, my big focus has always been the demand side of the equation, and demand has continued to be there for us, and I think it will continue to be there for us going into next year. And so I think that we think that next couple of years look pretty good, and in 25 and 26, I think it looks even better based on where we sit today.
And I think that's the importance of having a long tenured management team. You know when to go on offense. You know when to go on defense. You've dealt with all of these different economic cycles. That what did we learn from the last cycle? So that when it presents itself the next time, we either make the same decisions that we did that put us towards growth, or how do we avoid the same mistakes that we made so that we don't, put our foot in our mouth again all over, and repeat the same errors.
Yeah. Well, one of the things principles that I've also always anchored myself in, which I think, speaks to our ability to still be here 28 years later, is I've always, first and foremost, thought it was important to position ourselves for the downside, position ourselves for a tough economic situation, because when times are tough, a lot of companies don't survive, and or bad things happen. Dividends are cut, dividends are suspended. Dilutive equity issuances have to occur because you've overextended commitments. Bad things happen during downturns, and I've always, felt it critical that we first and foremost establish a strategy and capabilities with the platform to weather those periods better than most. Because the other thing that's also true is, in a recession, in a downturn, while you're also want to, first and foremost ensure that we're okay, it's also a time where you also capture some of the best opportunity in all that distress. And that gets back to making sure you've got the capacity on the balance sheet to be in a position to jump on that opportunity when it emerges. Because when you get into a really good period of time and the economy's booming and it's just all really, really positive, we're all good. I mean, it's everybody's happy, and it's easy, frankly. It's when times are tough is where you really find out what you're made of and what the strengths that you have as a company. And so I've always oriented our focus in first and foremost ensuring during that part of the cycle we're good.
It's very refreshing to hear you say this, because you're always thinking about the shareholder. You're always thinking about your end investor with their interest in mind. Got two more questions for you. So we talked about we're hopefully coming on the end of the pandemic. We're on the other side. Which of the post-pandemic trends do you think will be sticky? Would it be the hybrid work from home, on off, Sunbelt migration, smaller households, and which do you think will have the greatest long-term impact on the apartment industry?
Well, I think a couple things. One, I do think that some level of flexibility in how and where people choose to get their work done is going to be with us for the foreseeable future. I think that we've proven in a number of cases that a lot of workers can be pretty productive from home, and in some cases, some would argue even more productive. And so I think that the last 2 years is also, I think, just seems to just introduce a lot more thinking about work-life balance and some of those kinds of questions. And I think that the remote working and certainly the hybrid work model is likely to be a persistent thought and a persistent practice that we will see moving forward for quite some time. And I think that certainly works in our favor in terms of how we are going. We're spending a lot of time and energy introducing work from home features, if you will, in our communities.
I was going to say, does that mean more business centers now,
yeah,
like development?
Absolutely. Inside the apartment, as well as also we're in the amenity areas and introducing a lot of flex office space in the amenity areas that we're finding great receptivity to, a lot of appeal, and so I think that sort of practice that we picked up during COVID, I think, is going to persist. And then the other thing that I think has happened over the last couple of years is that momentum of people finding reasons to fall in love with the Sun Belt. That was there before COVID. I think it accelerated during COVID, and I think that a lot of a lot of focus on these markets has just continued to grow from employers looking to find reasons to pull jobs out of some of the higher cost regions of the country. So, I continue to believe that the Sunbelt migration trends are likely to remain pretty strong, and I think that will continue for some time as well.
As I mentioned, I live down the street from Market Center. Phenomenal property. I don't know how well, if you know off the top of your head, great location, Coit and George Bush in far North Dallas, Bricksmore Shopping Center right there with the Central Market. Yeah. And, I always, people ask me about the company, and I always reference that property because I see it every single day.
Yeah.
98% occupied, I'm guessing. People lined up out the door, freeway access right there. It's like the perfect place for you because you have all the amenities around there for that particular consumer. They're right by the university, 20 minutes from downtown. Everything is such a great location that I point back towards Addison Circle, your predecessor with Post, and Market Center. And I'm like, look, focus on these two properties here is a good example of the why of MAA. Look at what's around them. Mm-hmm. They're not in an island, and there's nothing, there's no infrastructure around them. They clearly planted their flag there for a reason. And it's just so cool for me to watch it because, again, I've known MAA for, my 25 years in the REIT industry, mm-hmm. but to actually see one of your properties right outside my door, I see it with my own eyes, and I know that it's, pardon me, kicking ass and taking names. Mm-hmm. So it's just really fun to watch.
Yeah. Well, thank you. No, it's a great location, as you say, great property. And that you've seen that growth, North Dallas has just been unbelievable.
You should try that Rosa's Tacos if you ever happen to find yourself at that property right across the street. All right. Last question. You are the largest apartment REIT by the number of units, over 100,000. So would you say MAA is a brand? Or do you strive to be a brand? Where do you find yourself as far as brand recognition?
I will say this. We are increasingly committed to building a brand. I think that as a consequence of the two mergers that we've been through, as a consequence of just getting to the scale that we've gotten to, but also particularly as a consequence of how we are altering how we do business on site and introducing a lot more tech-based tools and capabilities that I think are going to continue to add more value for residents. I feel like that there is benefit for us raising an awareness of our brand, if you will, both in terms of just visibility, as you were just talking about there in Dallas. We're going through a process of sort of raising the awareness that MAA is behind a lot of properties that are in the markets where we have a lot of concentration, Dallas, Atlanta, and places, other places, and increasingly as we raise the awareness just from a visual perspective with the naming conventions and getting a uniform naming convention in place. We are seeing more residents and prospects saying, I had no idea that was who you guys were at this particular, that's the company behind this particular property after having driven by it for years because it was called something and our name was not really evident there. And what I think, to a large degree, I think what's happening with the industry and is that while property-specific attributes are always going to be an important decision for how a resident decides to choose where they choose to live. The convenience of the location to the work or wherever they want to live, the amenities, and obviously just the look and feel of the apartment all really matter a lot. But I think as we continue to introduce more tech-based services and introduce more conveniences, I think what we're finding is that the company behind the property and the capabilities of that company are growing in importance. And I think there are advantages not only for our residents in raising that awareness of our brand, if you will, and raising the awareness of who's behind the property, but we're also finding that it resonates very well with our associates that work at our company and prospective associates in terms of understanding and appreciation the full breadth and scope of the scale that we have, the career opportunities that come from that. And we think that ultimately the ability to, bring value to brand for our residents and for our associates will lead to, also a value component for our shareholders as well. So short answer to your question is yes, we are committed to continuing to build an awareness of our brand and bringing definition to it, and bringing also an explanation as to how that's a good thing for residents and for our associates and for our shareholders. And I'm excited to see how this continues to play out.
As we mentioned multiple times as we wrap this up, we know how important management teams are to look out for shareholders and investors' capital. But Eric has told you repeatedly today how he is focused on you, the end investor and the end tenant, and your experience at their properties and owning their stock. And it once again proves why it is a top constituent of the Armada Home Appreciation US REIT ETF. Eric, I'm so honored, and I can't thank you enough for taking time out of your busy day ahead of earnings season to sit with us and tell us the MAA story today. Thank you so much again.
Well,
we really appreciate it.
I enjoyed it very much.
Thank you. We'll stay tuned again for our next CEO interview, and we look forward to continuing this ongoing dialogue and series with you guys. Thanks again.